Good morning and welcome to the ROCKWOOD Strategic PLC full-year results investor presentation. Throughout the recorded meeting, investors will be in listen-only mode. Questions are encouraged to be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Richard Staveley, Fund Manager. Good morning.
Good morning and hello to everybody, and thanks for your interest in ROCKWOOD Strategic. I think the last one of these we did in November, so there's been quite a lot of things that have happened since. That said, I'm well aware that there are people that are finding out about ROCKWOOD for the very first time, as well as people that are sort of seasoned watchers and some of our longer term shareholders, of which we've now got over 4,500. So hopefully some of it you will have heard before if you know us well. But there's a lot of new stuff about some of the investments we've been making in the last seven months and what we've been up to, including our recent results. So there's a disclaimer which I hope you all will read when you look at the slides again, or are well aware of. But just as a quick intro to ROCKWOOD, we are listed on the premium segment of the main London Stock Exchange. And we believe we're a very specialist and differentiated fund versus the other UK smaller companies funds and other UK equity funds that are around. And we think we are doing it in a very inefficient part of the London stock market. We target stocks that are below 250 million market cap. But quite a lot of our holdings are considerably smaller than that. And it's an area of the market that many market participants don't look at anymore. We target companies that we think can double in value over 3 to 5 years. And the way the maths works is that if they double over 5 years, we will get a 15% internal rate of return over that 5-year period. If they do it in 3, you get about 25%. And hopefully some of them will more than double in that period too. And those will make up for the ones that take slightly longer than 5 years or don't quite meet our target returns. We're a value investor. There aren't huge amounts, in fact, very few professional value investors in this part of the London stock market. Most are more growth orientated, which you think again is differentiated. And we run a concentrated portfolio. So we've currently got 20 holdings in the portfolio, and which we think also is differentiated and means we really win when our winners do well. We're also active managers. We really roll up our sleeves with all our investments and in our core holdings significantly so, and we get engaged with the management teams and boards of the companies that we invest in. We run the fund from Harwood Capital LLP. Harwood was set up by Christopher Mills, the legendary UK investor who he himself runs North Atlantic Small Companies and with Nick Mills, Oryx International Growth. But Harwood also has a private equity business. They're raising for their 7th private equity fund at the moment. And that network and of both Harwood's private equity team and our own network means that we have a really good insight into what's going on in the UK and a private markets perspective on our holdings. Finally, this is the only thing I do. You'd be surprised how many other fund managers have other things they're up to. But this is the only fund I run, and I'm fully aligned with it, as is Harwood. Me and my family have bought just over 1.2% of the equity in ROCKWOOD. And Christopher Mills has bought just over 27% of the equity in ROCKWOOD. So we really have skin in the game. So small companies, I always like to remind people of this because we've had quite a tricky period in the last few months, and just remind people of the long run that with small caps, again, it's not timing the market, but time in the market that really counts. I think the most important part on this slide is actually the chart on the right, which shows you the very long-term returns of investing in different size brackets in the London market. It shows you that £1,000 invested in 1955, compounded out over many years, would have delivered over £9 million invested in the bottom 10% of the London stock market. But interestingly, that same £1,000 would have become £22 million if it had been invested in the bottom 2% of the market. And it's actually that part of the market that we think very few people are actually really invested in anymore. And that's where Rockwood is. And as a result, hopefully drives better returns than the average small cap manager, as well as large caps generally. Apologise slightly for this slide. I could have updated it, but we tend to do it for the quarter ends, which you'll all know is in just a handful of days. But the performance through to the end of Q1 2024, which was the end of our financial year, we're really pleased about, given the difficult backdrop that we've had. AIM was down 8%, just over 8% in the 12 months to March, and we slotted in a positive result of 5.2% NAV growth. So we're pleased about that. For those that don't know much about Rockwood, you'll see that our longer term record really has delivered for shareholders, up 70% over the 3 years to March and 170% over the previous 5 years. I'm really pleased to say that since the year end in March, in the last few months, performance has really picked up further, and we're up about another 19% actually since the end of March, and I'll explain why that is shortly. Just on the right are some of the stocks that have driven this medium-term performance, the kinds of returns that we have made, both money multiples and IRRs. And this isn't really a kind of like a highlights list. It's actually kind of about 90% of the things that we've realised in that period of any consequence. And you'll see that we are consistently actually beating our target IRRs, which is why the performance has been so strong. So quick financial results summary. I do appreciate this is quite backward looking, but I think it's worthwhile just touching on what we've actually been up to in the last 12 months. We're really delighted. Rockwood moved from a discount to NAV to a premium to NAV. You'll all be well aware there are very few investment trusts in London that have actually achieved that or are sustaining that. So we're really pleased about that. That's allowed us to issue new stock to new shareholders who've joined. Hopefully some of you are listening today, and that's allowed us to scale the strategy further. That's really important. It helps us with cost recovery for overall for the strategy. But far more importantly, it actually allows us to have more capital to deploy in this universe. We can actually have more of an impact on the companies that we want to do. And in fact, on the ones where we regularly see issues that are 100 million to maybe 200 million, when Rockwood was really small, it was quite difficult, unless other Harwood funds came alongside us, to really claim we were sort of able to influence or really change what was going on in a business that needed catalysts for change. But as we grow, we'll be able to take really meaningful stakes in 100 million, 150, 200 million in Rockwood alone, and that will be really great for all shareholders. So we're super pleased. We've actually maxed out our raising, which we're limited at the moment to 20% on a rolling basis during a year, and that's why Rockwood's currently trading at quite a significant premium to its latest NAV. However, the AGM is on the 31st of July, and that will restart the clock with our permissions, assuming the votes go through, and we'll start issuing again from August. I think that's worth everyone just bearing in mind. During the year, we added to TriFast, which I'll talk a bit more about later, and also Nick Mills from Harwood went onto the board of TriFast as a NED. And at Titan, we also added to Titan, taking our stake up there. And we also injected Jamie Brooke onto the board there, who's become the chairman of Titan. And we also added to Hostmore, where there have been a couple of pre-submitted questions about, so I'll come on to that in a moment, but we've been adding to that during the last 12 months too. We also did a loan deal with Pressure Technologies, who had sort of quite disappointing results, actually, interim results yesterday. But that's a business where within the last year I've gone onto the board of, and we're trying to get sorted out. And the really good news actually in yesterday's results, it was slightly, I think, overtaken by a trading downgrade due to delays because of the election, is that their second division, PMC, we've put up for sale, and we've had interest, and we're in exclusive talks with someone to to hopefully complete that deal and acquire that division, which will focus Pressure Technologies on its Chesterfield business unit, which we think has very bright medium and long-term prospects. So the reason I've got the bullet in is because during the year they needed a bit more cash, and just shows the flexibility that Rockwood has alongside our equity positions. We did a really nice little loan, which we lend at 14.25% to Pressure Technologies. We also got some warrants attached to that loan, got full security over the business, which has a huge freehold site, massively asset backed, the Pressure Technologies share price at the moment. And I think that was something that was quite interesting that happened during the last 12 months. We haven't been sitting on our hands, though. We've got lots of new investments. So we invested in STV, which some of you will know is the equivalent of ITV in Scotland. It's the only remaining independent broadcasting company in the United Kingdom. But it's also got an emerging production studio, which used to be quite small, famous for Taggart and Catchphrase of all things. But it's really been growing, mixed through organic and hiring decent people, but also through acquisitions. And they've started to get a number of really quite impressive commissions from everyone from Netflix, NBC, the Game Show Network in America, continue to get recommissions from the BBC, and a really interesting part of the business that I think a number of investors seem to have sort of forgotten about or haven't bothered realizing is being developed there. We also bought into Restore, which is a document storage business. Capital Limited, which is a business that hires drilling rigs to mining companies around the world. And also James Fisher and Sons, which is a long-standing British business which has interests in shipping, marine and energy markets. And we'll touch maybe on some of those in a bit more detail shortly. We did have a number of takeovers, which were great, drove some of the performance of Rockwood and also locked it in. And we had takeovers of City Pubco, onthemarket.com, Finsbury Foods, which makes cakes, and Smooth, which was a conveyancing software company. We haven't actually had a takeover this year. We did have a takeover approach for Centaur Media, which didn't come through or wasn't realised. But I do think the pace of M&A, both possibly in the portfolio, but definitely in the wider market, is likely to pick up. And quite surprised actually we've had nothing in the first half of this year. Special mentions go to Galliford Try, wonderful business run by Bill Hocking, a fantastic CEO. And Galliford obviously focused on the infrastructure industries of the UK, builds hospitals and schools. Probably the likely change of government, probably good for that part of their business. But they're also focused on the broader infrastructure needs of the UK, the water industry, where they're market leader in particular, which we know needs a massive increase in infrastructure spend, which they should benefit from. But that business has both been performing for Rockwood, but also has raised its medium-term guidance, both for sales and for its profit margin targets. And we think is in fantastic shape, still a very cheap share. And finally, Filtronic. I have to try and hold back my excitement about this business, mainly because excitement means emotion, means you can make errors in investment. But the truth of it is that Filtronic has been really delivering for the portfolio, and not unrelated to the fact that Elon Musk has awarded Filtronic some very significant contracts from his SpaceX business, and has which they themselves have taken warrants exposure over Filtronic, which I still haven't. No one's actually sort of said it's not the case, but from what I can see, I think is the first UK share that Elon Musk has bought or got exposure to in the UK, which I think is a rather wonderful thing given the sort of level of sentiment currently. And yes, it's really rubbish, isn't it? Everyone wants to sort of downplay our country, downplay its future, and indeed write off the UK stock market. all these sort of headlines on the right are relatively recent ones. I totally disagree. I think there is the likelihood of a decent future actually for the UK stock market. And I think some of these headlines actually have probably finally reached what some people call the blob, or the sort of basically those that are in government or in the civil service, that this is a problem that needs addressing. And I think both the current government with its British ISA initiative, the Mansion House reforms, and Labour's comments on this matter of revitalising the British stock market, I think are all likely. The magazine on the cover on the left is Business Week one from 1979, which is called "The Death of Equities." I think it was a well-known headline at the time. I think we all know what happened and has happened since. So this just quickly on markets. So they still are super cheap. In fact, I've used this chart before. It's fully updated now. It shows you the relative valuation of British equities to global equities going back to 1989. The red bars depicting the scale of the discount. And you can see we are actually at the biggest discount ever now. And I was sort of thinking about this. It's not really been featured hugely in this election campaign. But it is true, and I'm not going to get called into any kind of Brexit debate, but the reality is you'll see that the discount that UK equities have widened out to sort of started around about the time of the referendum result and on going forward. And it wouldn't surprise me if Labour do win the election, that it may be a slightly more positive environment in terms of our relationship with Europe, but I wouldn't really read too much into that. It's just something that's been on my mind. But the reality is this discount is ludicrous. Many of our businesses are at least as good as many of the US businesses. And although there is this magnificent seven effect going on, we have loads of really very undervalued businesses on the UK stock market. On the right-hand side of the chart, you'll see that the cheapest ones are under 250 million, which is where we look. So the cheapest of the cheap are where Rockwood is looking for its best ideas. Now, what do we look for, though, in this huge universe? There's probably 700-800 stocks we can pick from. Well, we look for proven businesses, often with identifiable assets and a history of free cash flow generation, or at least a business model that's been proven it can be cash generative. We have a value mindset, as I've said already, and what we really try and focus is on mean reversion. So we really like companies that have whose profitability has got much lower than it was before, but where we think that's a bit of a sort of own goal type situation, where actually change and a different perspective, or operational change, maybe management change, or board evolution, can help catalyze unlocking that value or improving that profitability. And in terms of trying to do that, we engage with the other stakeholders in the business, which are the board, the management, but also importantly, often the other larger institutional or private shareholders that own the companies we invest in. And we sort of try and explain to them what we think needs to happen, and help them to sort of at least be supportive or not hinder change that's often overdue. We also do work on exit theses for our investments before we invest in them. Often for institutions, one of the reasons institutions don't come down to our size of market cap is they're worried about getting stuck in the stock, a bit of a lobster pot. Often it's because they've got open-ended funds. They're really worried. They've got outflows they've got to fund, so they're really worried about their liquidity and their ability to fund the outflow, even if they like the idea of the investment. We are very kind of realistic about this, and think very much about we can't rely necessarily on another fund manager to exit our position to if and when we think it's at fair value and the turnaround's been achieved. So we also think very carefully about what trade buyers, or maybe whether what could emerge, what private equity would do with the business, and would they be interested in owning the business. This is a chart I've done. I'm not going to go into detail this time around on this one. Apologies to those that are first timers, but in essence, we think this is a natural cycle that almost all companies go through, where they make an error or poor M&A, profitability collapses, and then everyone gets super emotional. The shareholders do, the management do, the board does, and then when that's all going on, you get this depressed valuation as well, on top of depressed profitability, and that opens up this opportunity to make money. And because if those things can be sorted out, then you can get a kind of improvement in profitability and an improvement in re-rating. That does require change. It does require often improvements to the balance sheet. But when it does happen, it will achieve, and usually does, our target returns. This is, though, however, is a newer slide. And I think this is just to remind you that we really are medium-term investors, and those that are thinking about Rockwood or are in Rockwood, just to remind you, we are everything where we are really are. This is a sort of 3 to 5 year holding period type fund, and that's what we do in the stocks as well. And very quickly, after our long due diligence period, or the significant amount of due diligence, sometimes they're not as long, maybe a couple of months, but they can be up to 6 months. This period it takes us due diligence a stock. We often buy what we call during the stabilization phase. This can be quite a volatile period for the shares, but we buy where we've established there are at least 100% upside in the shares, but we know the shares could easily go lower, and part of that change might involve the new finance director, and quite regularly that new finance director will find something else hidden in the down the back of the sofa, which isn't very pleasant, and the shares may go lower. But we'll usually buy with confidence on that we can then increase our size of our position and achieve target returns still. So that stabilization period usually takes 6 to 18 months. We then move into what the delivery phase. So maybe the management team's renewed, the problems are sorted, the balance sheet's been addressed, and that delivery phase is typically 2 to 3 years, or 4 to 6 financial statements and interim finals, that sort of thing, and that's the period where the profits are typically improving under the new plan. And then after that, the market starts to see a proper pattern of improvement, and you get into the realization phase. Realization being when the market realizes things are better now and people are more comfortable. More mainstream investors are comfortable buying it. Maybe momentum investors are now interested in the shares, and so the stock market realizes and re-rates it, or trade buyers realize that it's being sorted out, or private equity do, realize the stock market doesn't care, in which case the bid comes in and they realize the value for shareholders. And then the third piece might be that we feel that Rockwood may act as a catalyst even to try and push that the best way of us realizing value for all shareholders is to try and seek out a buyer for the business. The whole thing, as I've said, taking 3 to 5 years. It's a process slide. I'm conscious I want time for Q&A, but I think the most important thing in here is that I'm obviously lead fund manager on Rockwood, alongside Nick Mills, and we have an outstanding dealer called Stavros Jones working in the team. But we also have this investment advisory group, and the investment advisory group here, sorry, apologies for those that need glasses, but these are individuals who I trust, who are very high competency investors in their own right, including where Christopher Mills sits in relation to Rockwood, as well as a large shareholder. And when I go to a significant position, so by actively buying more than 5% of the equity of a company and going core in a position, I share my unfinished research with these guys, and I get kind of feedback from them on what other risks they think I might have missed, or what they think is the most important risk to focus on. They may know people at the company, or people that formerly worked at the company, or competitors, or suppliers, or have insights into the industry. And I find that a really helpful part of process through to deciding whether I want to go to a core position or not, or indeed have significant confidence to do that. So these are some of the stocks, some of the people that have gone into our businesses in Rockwood in the last 12 months. This is a previous slide, but I thought I'd just update on 2 or 3. I think really important is MC Saatchi. where Zilla has executed a fantastic acceleration of the improvement in their profitability, which is underway right now. They've also, since we last spoke, appointed a new CEO who comes with very high credentials and references extremely well. And also they've appointed it's a sort of nuance, but for the very first time, they've appointed creative directors of MC Saatchi, who are also very well regarded in the media industry. And we think that's an important development for them. We also note that both WPP and a range of other media companies are suggesting that advertising actually is slightly on the up now, and that will be very positive for that business. The shares are still very undervalued, have net cash on the balance sheet, and we think that really is in delivery mode now. So watch out for the next sets of results from M&C Saatchi. We've got a decent sized position in the portfolio in that. The second would be James Fisher. So James Fisher, we still haven't made any kind of return from our average investment in price into James Fisher. But we're very excited about the future. And we were buying that with a stretched balance sheet in line with what I was talking about earlier in the stabilization phase. But just in the last few weeks, they're completing the sale of one of their non-core businesses, which was focused on the oil and gas industry, exiting that. And that has realized about £83 million of cash for the James Fisher business, which has massively reduced the debt that James Fisher had, which we think has been one of the key impediments to the business being re-rated or really getting on the front foot. So the James Fisher balance sheet is no doubt now in a much, much better place, and definitely not a risky balance sheet anymore. That said, John and his new CFO, who joined earlier this year, will be driving a turnaround in the operational performance of the business and have outlined a material improvement in margins and return on capital as their medium-term targets. So we're quite excited. We are now, again, like MC Saatchi, moving into a delivery phase. So I'd watch out for that. Thirdly, Hostmore, bottom right, Stephen, who's from New York, I understand. And Stephen, just a nuance, he's going to he works at Sherborne, which is the US activist fund run by Ed Bramson, and is a very, very accomplished investor and understander of shareholder value. And he is the chair at Hostmore now, which is the business, for those that don't know, Hostmore, it owns the UK franchise for running TGI Fridays, the kind of casual dining brand that's has very high brand recognition and is used by families for parties and for office workers, and is actually the fourth highest, most recognized dining brand in the country. And Hostmore has announced a transformational deal, which is yet to be voted on. We'll be voting in favor of that transaction. And what it means is that they are reverse taking over the whole of the rest of the TGI Fridays brand globally, which, as you can imagine, is much bigger than just the UK franchise, including all of America and overseas. And what's important here is that twofold. It's firstly, most of the rest, not all, but most of the rest of the Hostmore of the TGI's business is a franchise business, so low capital intensity, high profit margin. And if you look more widely around the world at franchise businesses, they tend to be on high multiples. In fact, the average of the McDonald's and Wendy's and all those sorts of businesses, Denny's and things like that, is about 14 times EBITDA. Which is much, much higher than the Hostmore current valuation. We will end up, Hostmore shareholders overall will end up owning 36% of the combined business, which we think will have bigger scale, which means some new fund managers might look at it for the first time. It also means that their high debt load, which is the most highest debt load in the portfolio, and we have just under 2% of the portfolio in ROCKWOOD in it, is more likely actually to be addressed as a result of the deal. And they're currently in talks about a refinance now, which would go alongside the transaction. So we're really excited about the future for Hostmore, a stock that very few people, in the, particularly professional fund managers, have met over the years. And if they get it right, could be a multi-bagger stock for Rockwood. These are the core holdings, which haven't changed. There's no new ones in here. Trifast became core during last year as we scaled up that position. I just remind people that about two things here. So core holdings are ones where we own at least 5% of the company, and we want to have a minimum of 5% weighting in a core. Now, it's a bit frustrating, but sort of as a result of a good thing, is that because the fund has grown so much, I think we troughed at 35 million size, we're now 80 million in NAV. Two or three of these positions haven't been able to scale with the size of the fund. So much as I'd like to, Titan is now down at 2.7%, and equally with Centaur Media, the problem being that Harwood alongside Rockwood own 29.9% of the company, so we can't buy any more of it, otherwise we'd have to launch a bid for Centaur Media. So we can't buy any more of Centaur Media as a house, as it were. So some of those positions aren't quite as big as I would be happy having them in the portfolio, but all of them we're heavily engaged with. And in fact, of these 7 core positions, of which we at least own 5%, we've got board positions or have proposed a board member onto 6 of the 7. So huge influence, which is really important about driving the outcomes here. The second thing is, alongside Rockwood right now, Harwood have a few RM shares, so I think we're at about 15.5% of RM. Trifast, we're at 15% at Harwood in general. Harwood and Harwood affiliates are at 29% of Flowtech Fluid Power. Pressure Tech is as is, same with Titan and Van El, and as I've already mentioned, Centaur. You'll see also that these market caps are all under 100 million. I think, yes, just very briefly, actually, what I'll do is I'll talk about RM and Trifast now. So what we'll do is, yes, so RM, largest stock position, we started buying at a 25 million market cap. It's now 70 million. And as you can see there in the penultimate bullet, we think that this business is worth 170 million. So we think there is significant upside to shareholders still in RM, which should drive huge NAV growth for Rockwood in the coming quarters. And why that we expect to be is that earlier this year, the board have actually announced a strategy in line with what we'd been asking them to have as the strategy, which is to focus the group. And for me, what focus means is selling at least one and likely 2 of the divisions. And the first division to be sold is likely to pay off a considerable amount of the high levels of debt that RM have, and that should take it significantly off the risk ladder that it's on at the moment. So we think that now they publicly stated they are going to refocus the group. We would hope to see a transaction from RM during this calendar year, so the next few months, which should completely transform this business. The second thing that's happened since we last spoke on Investor Meet Company was that they have also announced a fantastic new contract with International Baccalaureate for their assessment division. This is a fantastic division within RM that does marking of exams. It marks a number of those. You can see them at the bottom of this slide, but they mark the Institute of Chartered Accountants exams, and they do A-levels and GCSEs for Cambridge assessment. But they've won a multi-year, tens of millions of pound contract for International Baccalaureate to digitalise their provision globally. And I think that just places RM absolutely at the forefront of exam marking in the new world, which is moving to gradually globally. And that is a very exciting proposition and opportunity for them. They already sell overseas, but it's clearly growing overseas as well now, as well as in the UK. It's also a very profitable business with over 20% margins. So we think that is an absolute gem hidden in RM because of concerns over debt and the other 2 divisions which aren't as profitable as the assessment business. The second is Trifast, another core holding. And again, we basically haven't made any money on this yet. So this is where, it's in the portfolio at our average in price, pretty much, which is around 70p. We think the business is going to at least double in value in line with our usual expectations. And why we think that is because they're currently making about 5% margins, just over that. And we think they can make 10% margins. They used to make 10% margins, and their competitors typically make at least 10% margins these days. And there's been a full suite of management changes. So we've got a new chair, new CEO. They're just about to come out of the stabilization phase. So the new CFO is yet to be appointed. We're hoping for a really good person there. But once that CFO's in, we should be able to start to move into the delivery phase, because Ian joined last September, and there was some restructuring in the UK, which started last year, which we'll start to see the benefits from during this calendar year, we'd like to think. So that business, if it does do 10% profits on its sales of 240 million odd, we think is grossly undervalued. And we would expect the business to be, valued in excess of 200 million market cap, which would be, less than 1 time sales, which is, arguably being unfair on the business, which is successful both in Asia, US, Europe, and the UK, making nuts and bolts and distributing nuts and bolts fasteners. So the second type of holdings we have are called springboard / opportunities stocks. The springboards are ones that could become core but haven't quite yet, either because we haven't been able to get the liquidity to take our position to a 5% position, or we think it's got the potential of becoming core, but we just haven't got our heads around, haven't been able to do the right level of due diligence to go to core yet. But at some point it will. And opportunity stocks are ones that we just think will meet our target returns in our target market cap area, where we think we don't have to be quite as labor intensive in terms of our involvement in getting things to happen. Maybe we just notice that it's all being done, but no one else has noticed, and we'll just buy some shares on that basis and sweat the capital that we've got in Rockwood, rather than just sort of sit on cash. And these are not all of them, but nearly all of the springboard opportunities. We've currently got 14 now, springboard opportunity stocks. There's 2 I absolutely have to talk about. The first is Funding Circle, which I've got a slide on, so I'll talk about that in a moment. I touched on Filtronic earlier. You can see it's a big position now in the fund. It's done really, really well for us. But Filtronic is currently potentially about to have another big value creative event. Their products have been designed now into the ground stations, which fire up the signals for the Starlink satellite network that Elon Musk has put up around the world. And they've got into that program now, and that's really what's been driving the shares. We believe in prototype trials for a completely separate product, which would go actually into the satellites, of which there are multiples more satellites than there are ground stations. And if they are successful with that should lead to significantly more contracts for Filtronic. And this whole area of low Earth orbiting satellites, which Elon Musk is the market leader and really the only person that's doing it with any scale so far, is probably not just going to be something that Elon Musk does. You may be aware that Jeff Bezos also has plans to put his own network up into space and of satellites, and as are a range of other people for various different reasons, both corporate, government, and otherwise. So this whole market is opening up, and it does look to see as if little old Filtronic is positioned very nicely to benefit from that. And as I mentioned earlier, Musk's now actually been happy to take equity exposure to that business alongside his contracts. I mentioned most of the others of the rest of this. There have been a couple of questions come in before pre-submitted actually on Argentex. So why don't I deal with Argentex now? Not everything goes right in Rockwood, and I wouldn't want anyone thinking our performance is because can't be sustained because everything's going well for Richard and Rockwood. It isn't. Argentex has been a bit of a nightmare, to be frank. Argentex, for those that don't know, is a FX services business, which to small and medium-sized corporates and also to sort of institutions, financial institutions that need FX services. It's disintermediating the banks who don't do a very good job at this, tend to charge too much and have awful service. And it's tried to be a bit of a fast follower, and let's face it, not as effective as a much better known stock in the London stock market called Alpha, which is currently on 5.5 times sales, is a highly profitable business making 35% operating margins, doing a not dissimilar action service to Argentex. We bought the stock as a kind of opportunity stock. We weren't planning to get to a bigger position in it initially, and at 70p, and we did start selling a few shares at £1.37 a while ago, and I regret not selling more at that point. The company's then gone on to have a couple of profit warnings, and it's turned out that the changes that we thought were going to catalyze an improvement in prospects have not worked out, and the new management team that was put in place when we were buying has actually needed to be replaced. So there's now a new chair, a new CEO, and an interim CFO that we expect to become a permanent CFO shortly. Their business plan is to try and develop alternative banking products, which Alpha has done successfully, which tend to be valued more highly and a kind of higher profit margin and more sticky, and thus rated thus so by the market. And this is going to take some time to do that. And they've also decided to raise some money to help accelerate that process. The previous management team had increased costs materially and misforecast the rate of growth in the year following the helpful activity they had with Trust. In short, though, because the nature of the questions is, what are you going to do now, Richard, with your position in Rockwood? Well, we think the current shares are grossly undervalued under all circumstances. So the business has loads of cash, is inherently profitable, maybe much lower than it was, but is inherently profitable, and has the scope to materially increase its profits going forward. We also think that the market forecasts, which were updated actually this morning by its house broker, look to us to be very pessimistic, because we have been going through a period of very low FX volatility. So we think there's going to be a few upgrades coming at Argentex. We also think that the new team probably have a decent chance and the skill sets to probably effectively develop these alternative banking products. However, we would say this is that we think that could take some time. And we think that Argentex would benefit from being part of one of the other existing players in this space. And we think it would be hugely beneficial for one of the other players in this space to acquire Argentex. And given its current valuation, it would make a huge amount of sense for any acquiring company. So they'd have to pay a very significant premium, but they could still make a very good return, we think, by doing that. They would essentially, in a transaction like that, you would just inject Argentex's great clients into maybe the existing products that are already rolled out, that those clients can't access at Argentex. You would keep all the best people, you would lose the PLC costs, and we suspect that would be something. So we think that could easily happen over our time horizon. Just to be clear, we've owned the stock for a couple of years. This is a reset point. We still think we've got 2 to 3 years for our full 5-year play for this. We're definitely not selling shares at the current share price. I've been prompted about timing. Sorry, everybody. I do think I want to spend 1 minute on this, then I'll go to summary and then Q&A. So Funding Circle. Why I want to do this is because it just so encapsulates what Rockwood's doing and why we can keep powering this fund forward over the next few years. Funding Circle was listed by Goldman Sachs for 1.5 billion market cap in 2018. In February this year, the market cap had got to 110 million market cap, despite them stating in the results that they had 175 million of cash, unrestricted, further 50 million of cash linked to their regulatory requirements and business model, and a 60 million odd loan portfolio, which they've been has been fairly marked as far as we can see and from recent sets of results. So huge amounts of value and a massive discount to that hard, of which mostly was cash value. Problem being, they've been a loss-making business. Albeit that those losses have been consistently getting less, and that they're on pathway to one day being a profitable business. At which point they've become a platform business, not akin to Hargreaves Lansdown, who many of you might be invested through. But once they become profitable to cover their technology costs of this amazing lending platform that they have, the basically drop through profitability is extremely high, and we think would support a very high multiple for the cash flows coming off the platform. So we started buying in February. We engaged with the company. We rolled up our sleeves. We met the board, the management, the advisors, and we asked the obvious questions. Why aren't you doing a buyback? It's just ridiculous. Why aren't you cutting your costs more to accelerate the move through to profitability? And fantastically, since we purchased, they've cracked on with all of those things. They've announced cost cutting, which we're really delighted to see. We think that's been well overdue. We've seen an initial buyback of 25 million. We think they can afford more. And then something we weren't expecting, but it seems to have occurred and is definitely positive, is that they had some offers for their US activities. And actually earlier this week, that was announced that they have sold those activities, exited the US, which was a big loss maker, for 33 million in cash. And we suspect that will lead to an enhanced buyback going forward. Now, we've obviously made a very strong return from our funding circle holding position, but we think the business could easily make 30, 40, 50 million of profit in the coming years, which we'd expect a teens type multiple on. So we think that there is, and then you've got the cash as well. So we think this business still has significant, and these shares have significant upside. I'll talk about the market if I've got questions about the market, but just to conclude before Q&A, value bias, proper small cap bias, and the markets are depressed and people are a bit upset and emotional. We're putting a lot of experience into this, and it's specialist and dedicated experience to this strategy, which we think we've proven now. We're targeting stocks that can double, but over the medium term, and we're 100% focused on it, and we've really got high confidence in this current portfolio. So, right, I'm not sure what happens now. Do we go straight to Q&A?
Absolutely. Look, Richard, thank you very much indeed for the presentation. As you can see, we've obviously had a number of questions throughout today's presentation and pre-submitted. Thank you to all the investors for submitting those, and do please continue to submit your questions. Richard, perhaps if I could just ask you, there are quite a few, I know some of which you look to have covered off in the presentation itself, but if I just ask you just to click on that Q&A tab, start at the top, work your way through to the bottom, read out the question, I'll pick up from you at the end.
Okay. There's a question about Argentex. Can you comment on the reduction of your holding in Argentex and your commitment to the company? Okay. So as you said, I'm not selling the shares now. We started buying more Argentex, sort of averaging down a bit in our position at the back end of last year. And in the start of this year, we actually just kind of reassessing the risks around what the new strategic review might be, on the size of our position, really relative to the other sides of the position, and we started making a small trim to it. We then actually became inside as a house on their desire to raise money. So we haven't sold any more since. It was just a small amount. We're not proposing to sell any more currently at this level. Can you explain how you trade? Is there enough liquidity to buy positions from the open market, or do you have to rely on block trades? Well, we don't trade that much. It's a bit old-fashioned, but a bit like Buffett. We kind of most focus on the original purchase and averaging in, building up the original position size. And then we're mostly focused on the exit value and not really what happens in between to the share price. So we don't trade very much, very low level of turnover in the portfolio, other than that forced by takeovers. It's true, we have to be quite smart about how we build our positions. I mentioned Stavros, he's extremely well connected in the London market, and that's very helpful. But we typically do, as the person that's asked the question asks, do you rely on block trades? We typically do rely on large lines of stock. And for instance, I can, actually newsflash to all those interested in Rockwood Strategic. You may know there's another small trust that's tried to do the same strategy as Rockwood, but hasn't performed as well as us, called Downing Strategic Microcap. They're in wind-up mode, and as a result, they do have to exit all their positions. And we bought a position for Rockwood before, 3.5 years ago, called National World. And we bought the stock at 11p a share. And we actually sold it in 2022 at 29p a share to Downing. And we have just bought that stake back from them at 13.5p in the last few days. So that would be the kind of liquidity we do. We've taken a 4% stake in National World. That's literally hot off the press. But we also get our liquidity through the need for financing. So often some of the companies, when we're building the position, the balance sheet's a bit stressed, and we can help them raise money. We will cornerstone maybe the raise to improve their balance sheet. Here we go. STV, do you have a fair value share price target? Also, you have previously talked about the company being a possible bid target from a larger broadcaster, but do you not think that regulation will get in the way of that happening? CMA authority. Good question. So twofold. Yes. So our original price target, unsurprisingly for STV, was at least 100% upside. And I can tell you we started buying at 182p a share. So our fair value target is at least £3.64. For STV. We also do we allow ourselves to evolve that price target over time if things change. We haven't yet done that, but it is possible that companies can prove there is more value, or maybe even slightly less value as time progresses. But we're pretty comfortable STV has at least 100% upside. With regard to bids, we don't think there's any issue with this at all. ITV actually did acquire the other regional broadcasters. And in itself is a regulated company. So we think ITV could easily own STV. That said, it's a national broadcaster, it's the media, so any transaction is likely to have a kind of sign off that people are happy with the owner of STV if it was bid for. We actually see ITV. I mean, they'll probably deny it or give reasons why they're not going to do it, but we think ITV is would be a perfect owner of the business. STV actually has a fantastic contract with ITV around how it accesses its production content, and that deal we think is very much in STV's favour, which ITV would be able to kind of basically tear up if they own the business. And consolidating the whole of the linear broadcasting of STV is fine within the ITV network. But we'll see. I would say it's not the only outcome that could happen with STV. Their studios business is going to be over half of the profits going forward. Is less becoming a broadcaster and almost more a kind of a studio content production business. And we'd also just finally say it's been saddled with a very difficult pension fund issue, big deficit, and having to put a lot of money into the pension fund issue. And we think that's going to be resolved during our time horizon of our investment. And if that happens, we think the shares will perform very strongly. Your results don't mention Centaur Media. How do you assess developments there? Well, I did touch on it. I also just have to say I'm a non-executive director of Centaur Media, so I will choose my words carefully with regard to that. And Harwood owned 29.9%, as I mentioned earlier. And well, the management team have done a very good job of delivering on their promises to turn around the profitability of Centaur Media, which was very depressed 3 or 4 years ago. And in the most recent results, they're making roughly 23% EBITDA margins. The stock is on a very low valuation, and we think we are just surprised that people have not picked up on the quality of how the quality of that business has changed over the last few years. In as much as they used to be print driven by advertising, and now things like The Lawyer, which they own, which is an iconic and fantastic brand, is very much a subscription business. So we think the business quality is very much higher than the look-through multiple, which I think on market forecasts is roughly around about five times EV/EBITDA. The company also has significant cash balance on it, so there's no kind of risk around that. I think it's fair to say that the top line growth of Centaur Media has primarily been driven by their fantastic mini MBA product, which they developed, which is a paid for MBA in marketing, which a lot of corporates and individuals have now been signing up to. But Xing out that, the top line growth rate has been it's probably not as strong as everyone would like, and I think the company's now focused on delivering that. And they've recently come out with a target of 60 million of sales versus 40 million of sales in the next few years. There has been this private equity interest which fell away, so we'll see what happens going forward. Yes, ROCKWOOD recently took a 3.4% stake in Funding Circle after the sale of the loss-making US business. What is view on the valuation and profitability? Yes, we are processing. We're actually processing our own internal model at the moment to make sure we are right. But the company have stated that they're expecting the business to make, I think it's 15% plus margins going forward at Elite, which we think they at least be able to do. And we think that originations from the UK could get up to maybe 150 million a month. When you drop that through, we think that the profitability of the business quite easily gets to 25-30 million of profitability, and could be quite a lot more than that. The US business was heavily loss-making, and would have taken a lot longer to get into profitability and quite a lot more capital because of the nuances of the US. They had to do a bit more lending alongside the products they had out there. So we're very excited that it's going to be they'll be producing their first profits, having never produced a profit yet, in short order, and that should attract a new swathe of fund managers actually to that stock. Why is ROCKWOOD at a premium yet NASKIT and Oryx are at sizable discounts, while all under the oversight of Chris Mills? That's quite a difficult question for me to personally answer, but I would make a couple of key differences because people do wonder about what are the different factors and such. I think North Atlantic does have a considerable percentage of its money in private investments. I think it's just under 30%, I believe. And the market more widely is tending to discount private investments materially in stock in funds that have private investments. For what I understand from Christopher, he assures me and anyone that will ask him that in fact it's quite the opposite with the NASKIT private positions. They actually might be very cheaply marked, very conservatively marked, but that may be something that's feeding into that. And with Oryx, I wouldn't be able to explain why. I'm not sure. So I think I've probably done as much as I can on that. I apologize if that's not as good an answer as you would like. Someone's asked, can you talk a little bit about Restore? Yes, it's a fantastic AIHT stock for those that buy stocks individually. having a good exposure to it in Rockwood. We've got about 4% of the portfolio in it. It's a business I followed for many, many years. I was an investor in a previous job in the business when it was run by Charles Skinner, who has returned as CEO. So he was CEO for many years, built the business up, did a fantastic job, and then kind of left. And then it's been brought back because it didn't go very well after he left the business. He is very excited about the prospects for what the business has now. And just to remind you, or explain to those that don't know it, their core business is actually document storage. So literally paper, which is often needed for legal purposes or health records, and a range of other reasons. Paper, we seemingly can't get rid of it completely. The key there is to have scale, to have cheap storage facilities, and then great service of getting your boxes back. And then around that, he built up the other services which naturally go alongside document storage, such as shredding, where they're the number 2 player in the UK, scanning, where I think they're the number 1 player in the UK. They also do office locations, which was actually the sort of acorn of where the document storage business came from many, many years ago. And they do IT destruction. So they kind of can offer basically everything you need if a company decides to move offices or descale. When you do that, they tend to get a lot of business. It's very cash generative. The document storage business is making margins in the 30s, and it's and generally all to cash. And if you look at the valuation of Restore, it's on a major discount now to its PE ratings that it's been on for the last 10, 15 years. And we expect Charles to start delivering upgrades and a re-rating during the next 12 months. As you're concentrating on very small companies, do you feel there's a maximum optimum size for Rockwood? Strategic. Mark H has then said something very nice, but I won't read that out, as that's very kind of him. The maximum size of Rockwood, we've said, is 250 million pounds. We don't want to get any bigger than that, and that's because we're targeting under 250 million pound companies. We run about currently 20 holdings, but we'll be up to about 30 holdings by that point. We've been trying to get up to 25 holdings for the last 2 years, but our companies keep getting taken over before, and then we keep having to rebuild the holdings. So that's about the size that we'd like to get to. Yes, can you talk a little about the host? Someone's asked about Hostmore again. I did mention it earlier, but just so the way we understand it is this: there are no forecasts out there at the moment because no one covers it, which is even really quite exciting. They'll have to bring those out when the deal gets consummated. The deal gets consummated when they refinance the debt, which is a sort of precursor for the deal being consummated. So I think the order of events will be refinance announced, deal happens, relist it, then new numbers from the house brokers. If you look in the documentation, it looks like the business combined was generating about 30 million of free cash flow. Wow. One might think Hostmore's market cap is about 27 million market cap. So if they can return to or deliver 30 million of free cash flow, a kind of market discounted free cash flow yield would be about 10%. Again, I'm just using very simple maths to get the point across. That would deliver a market cap of 300 million. And Hostmore shareholders will own 36% of that vehicle. So our value that Hostmore would have in that instance would be, a tad over 100 million versus the current market cap of 27-ish. So that's why I'm excited. There might be significant amounts of upside here, and one to watch. That said, it's not without risk. They have got a lot of debt, and trading's quite tricky. Although I've been tipped off that the benefits of the wonderful Taylor Swift is quite relevant to Hostmore, who are doing lots of Swifty style events at their various restaurants, and I know they do actually have one at the arenas. So they've been trading, I'm sure, extremely well. around Taylor's tour. Ben S. TriFast operate in a very competitive sector. How confident are you they can increase margins to over 10%? And inventories and finance costs seem quite high. Please, could you comment? Yes. Okay. It is pretty competitive. That said, a lot. The way they get around that is the sort of communal garden, sort of mainstream nuts and bolts, and then there's, say, for instance, being the fasteners on in a Ford Mondeo, which are sort of designed for the Ford Mondeo, and then as long as the Ford Mondeo is being built, your fasteners are ordered for it, and it's very difficult to displace you for it. So that's how they deal with that competition. There, they actually have unbelievably long. I think it was on my slide actually. Long relationships with their clients around the world. So, for instance, fun fact for the day: the London black cab, now made not by manganese bronze, but the Chinese, but that has 270 fasteners in it, and TriFast do all 270. So every time a new black cab is made, they get the order. Their fasteners are used on that. So I am confident that margins can be increased to 10%. Another reason why I'm comfortable about that is because they already make 12 to 13% in their Asia business, which you might think would be the most competitive, but actually they make 12 to 13% in their Asia business. So we see that competitors make at least 10% as well. The inventories have been high. They are coming down, though. We think that was one of the areas that this management team were asleep at. So you asked about that, but we think inventories will be coming down. That will generate more cash, which will pay down the debt and then reduce the finance costs. So I think everything is going in the right direction, Ben S. Angus has asked, could you please provide some insight into your 3 to 5 year view for the Flowtech position in your fund and what top line growth rate you're expecting over the medium term? Thanks. Okay, sure. Flowtech, this is one we have. Actually, I don't want to start to make it competitive within the ROCKWOOD CEOs, but Mike is absolutely first class. Mike England, who's the new CEO, he's been there just over a year, maybe a year and a bit now at Flowtech. Very high class. Came out of Electro Components where he was COO, and this is his first PLC leadership position. And we think he's the right man for the job. Very excited about what he's going to do. Now, this is one where I talked earlier about that you can evolve your thesis. You have to be very careful about it, but you can, if the facts change, you should evolve your thesis, both about upside and also about target returns. And it's fair to say that when we first purchased Flowtech Fluid Power, I had a target margin of about 11 and a bit percent. I thought they make between 11 and 12% operating margins. Mike has publicly come out and said he's targeting mid-teens operating margins, which is a considerable increase in potential profitability for this business. We don't think that's going to come out overnight. And Mike's been very clear in the last 3 statements that the actual end markets for fluid power and pneumatic components, hydraulic components into the manufacturing industry, mainly in the UK, they've got a bit of Europe, but mainly UK, has been quite tough. So he's trying to turn this business around through internal actions mainly and a new go-to-market strategy with quite a difficult market environment. Because their customers are across all industries, it's pretty much a GDP play. And this is why I mentioned this, to answer your question specifically. They're always going to be a bit anchored around what GDP is. But we also think that there are adjacent markets that they're not in, that they could be doing more business with the customers that they have. And we would expect the top line growth rate to be more like kind of 4-5% is probably what's achievable once he gets things humming. That said, 4-5%, that's pre-acquisitions. So no acquisitions currently planned, but he could easily start doing acquisitions to augment that. And scale and distribution creates a lot of value for shareholders. But secondly, the profit progression is going to be miles faster than 4 to 5%, because he's taking the business from 7-8% margins to now we're talking maybe 14-15% margins. So we're going to get a doubling of profitability underneath that revenue growth. So very excited about that business.
Richard, just to jump in there, you've been super generous with your time. We've just gone through that hour mark. I know there's every time you have one question, another one comes in. So, and just slightly conscious of that. So appreciate you overrunning. But if there's any other questions that you want to just take before we wrap up, or just give some closing comments to the attendees, that'd be great.
Yeah, so I think I'll just wrap up really. It's very easy when you look at the ROCKWOOD share price and what we've been doing to think, oh, like with some company shares, like, oh, I've missed that. So, I won't get involved. I think I'm very comfortable that the gains that we've delivered in the current NAV, quite a lot of those have been locked in because the company's been taken over and then gain is there. So really the question is, are we redeploying the money well to keep driving the NAV forward? And I'm just delighted that something like a funding circle has really done that for the fund. So and you have to ask yourself, is this the environment where we can continue to deploy money into mispriced UK stocks? And the answer absolutely is yes. The premium on the shares is quite high now, speaking candidly, because I do want everyone to have a joyous experience with ROCKWOOD. We aim to grow the NAV miles more than the current share price over time. But I wouldn't be surprised when we start reissuing shares that the NAV, that the premium moderates slightly, and we'll see what the NAV is by at the time we get to that point. But the reality is that we do have a very solid and loyal shareholder base that are really benefiting from this differentiated strategy. And we're really excited about the next few years. So thank you all for your interest, and hopefully that's been a useful update on the portfolio.
Richard, thank you very much indeed. Thanks again for being generous with your time today and covering off so many questions from attendees. Can I please ask investors not to close the session, as you'll be automatically redirected to provide your feedback in order that Richard and the team can better understand your views and expectations. This will only take a few moments to complete, and I know it's greatly valued by the company. On behalf of Richard and ROCKWOOD Strategic PLC, we'd like to thank you for attending today's presentation, and good morning to you all.
Thank you.